Welcome to the deep dive. Today, we're going to cut through some of the market noise. We've got the latest North American tech sentiment and positioning report right here. Our mission really is just to quickly pull out the crucial stuff for you, the listener. We want to show where investor enthusiasm is peaking and maybe where a little caution is creeping in. So this deep dive, it's all about understanding that crowdedness and the shifting sentiment in tech. We're aiming to give you factual, actionable insights.
Absolutely. And understanding these positioning dynamics is just so critical right now.
Yeah.
Especially with this almost daily refresh of AI enthusiasm. These insights give you a real edge in reading the market's pulse, navigating what feels like a constantly shifting landscape.
Okay, so let's unpack this report. First up, what it calls the cleanest expression of AI, that's hardware and semiconductors. This area isn't just crowded, it seems like it's maybe the most congested part of the whole market. Sentiment is hitting new highs. What I found kind of surprising, though, reading this bit, was that even though hardware is so widely held, generalist money is still pouring in. It's like nobody wants to miss that boat, no matter how full it looks.
Yeah, it really highlights this persistent, almost singular conviction in this space. I mean, look at NVDA. It's a perfect 10 on their positioning scale. That means it's about as widely held and liked as a stock can possibly get after a bit of a rocky start to the year. It's just soared over 90% from its April low. Now it's got this staggering $4 trillion market cap.
Wow.
It really is the market's conviction in one stock. But, it raises that question, is this justified belief in AI's future, or is it just a very, very crowded trade waiting to tip over?
Right. So if NVDA is the undisputed leader there in that crowded hardware space, who's sort of next in line, and are there any, differences in their story investors should be watching?
Well, another huge one, almost as loved, is Microsoft, rated 9. Its story, though, it unfolds a bit differently. It seems to have firmly broken out of that, an 18-month holding pattern, added something like $650 billion to its market cap just this year.
Okay.
It's seen as sort of an easy core long for most growth portfolios, right?
Okay.
It's just perfectly positioned across generative AI and public cloud trends.
Okay, so if that's the AI hardware boom, what about the internet sector? The report suggests sentiment there is, more complex.
Absolutely. The report does note this sector is pretty crowded, too. I mean, It's got some incredible year-to-date winners like RBLX up 93% and Netflix up 41%.
Huge gains.
Yeah. But while some of that earlier enthusiasm for what the report calls tariff-immune compounders, basically internet names less exposed to trade friction, while that's softened a bit, investors are now really balancing these quite rich valuations against what still look like strong, intact long-term stories.
Yeah.
So the question becomes, how much growth is already baked into the price?
That's a really key tension point, isn't it? Like Meta, for instance. It's an 8.5 on their scale. Still widely owned, sentiment broadly positive. But there's been a slight uptick in caution lately. Does the report get into why that caution's emerging? Is it more than just ROI or maybe just investor fatigue setting in?
The report suggests it's probably a mix. Strength is expected this quarter, sure, but those longer-term uncertainties are starting to surface again. Discussions around the return on investment from big spending like hiring sprees, massive data center build-outs, often kind of hitter costs, those are coming back into focus. It's a sign investors are looking for more tangible returns from those really big bets.
Interesting. And this contrast leads us nicely into software, where the report says sentiment broadly continues to tick down.
Yes, that's right. For software, AI isn't just seen as a boom. It's seen as a potential disruptor. And this isn't just like general uncertainty. It feels more like a fundamental reevaluation of how AI might actually cannibalize some traditional enterprise models.
Yeah.
IT services and ad agencies, those are the spots where you see the most market negativity within TMT. The prevailing belief seems to be that AI could aggressively eat into their traditional businesses over time.
Exactly. A very different narrative playing out there. Okay, and finally, let's quickly look at Google and Apple. The report suggests they're starting to feel like clear outliers, with investors getting more cautious. OGL at a 6.5 has apparently seen a fair number of long positions shaken out this year, making it feel like a material underweight for many managers.
And Apple, AAPL, at a 4. That's a very clear outlier from a sentiment and positioning perspective. It's the largest underweight for mutual funds, and it's been a popular short for hedge funds. So betting against Apple or just holding the rest of it has actually been a significant source of outperformance alpha for a lot of funds this year.
Right. The stock's down, 17% compared to the NASDAQ 100's 9% gain? That's quite a divergence.
It is. And while a beat is expected this quarter for Apple, those long-term uncertainties about its competitive positioning, they remain pretty high.
Okay, so let's try and tie this all together for you, the investor listening in. We've seen this continued crowding in hardware and semis, the cleanest expression of AI. Generalist inflows are still persisting there. Look at NVDA at a 10, MSFT at a 9. Then you've got internet companies like RBLX and NFLX, both with impressive double-digit gains this year. Crowded, yes, but facing that valuation versus narrative question. And then finally, that downtick in broader software sentiment, particularly hitting IT services and ad agencies because of AI uncertainty.
It really underscores that critical balance investors are navigating right now. You're trying to embrace the universally loved stocks while also evaluating the pretty significant outperformance that's been found in underweights like Apple.
So here's a final thought to leave you with. Given these really stark differences we're seeing in investor sentiment and positioning, how might the market's continuous reevaluation of AI's long-term impacts reshape the opportunities and maybe the risks across your own tech portfolio?